The US stock market just wrapped up a significant week. Stocks are close to record highs, but many conflicting signals are in play. Inflation appears to be easing. The Federal Reserve faces a tricky decision on interest rates. Corporate earnings are robust. Artificial intelligence keeps investor interest high. Yet, oil prices are rising. Treasury yields are up. Consumer spending shows signs of weakness. Concerns about the global economy linger. In response, the S&P 500 achieved its third consecutive weekly gain. However, the Dow Jones Industrial Average declined. The Nasdaq barely moved. Investors now ask, can the stock market rally continue? Or do rising oil prices, high bond yields, and economic uncertainty create new risks? Welcome to your Stock Market Weekly Recap for August 10th through August 15th, 2026. Let's dive into everything that transpired. Before we start, a quick disclaimer. This video is for educational purposes only. It doesn't offer financial, investment, tax, or trading advice. Stock markets can fluctuate rapidly, and past performance doesn't guarantee future results. Always do your research and consult a financial professional before making investment decisions. Let's begin with an overview of the overall market situation. The major U.S. stock indexes finished near record levels. The S&P 500 closed at about 7,785.76 on Friday. Although it dipped 0.2% on Friday, it gained approximately 0.4% for the week. This marked the S&P 500's third straight weekly increase. The Nasdaq also ended the week up 0.1%. Conversely, the Dow Jones Industrial Average fell about 0.6% over the same period. The Russell 2000, which tracks smaller companies, rose by approximately 1.1%. This is noteworthy because it suggests that broader market participation may be improving, moving beyond just large tech stocks. Although headline numbers are calm, significant movements occurred beneath the surface. The week opened with investors buoyed by a solid period for U.S. stocks, thanks to strong corporate earnings and Federal Reserve expectations. Monday saw some profit-taking as the S&P 500 slipped slightly. Similarly, the Dow and Nasdaq also saw declines. Notably, oil prices rose, which stirs inflation concerns as energy affects many costs in transportation and production. Inflation became the week's primary economic story. Encouraging U.S. inflation data indicated less immediate pressure on the Federal Reserve to raise interest rates. Lower inflation gives the Fed added flexibility. If inflation can drop closer to the Fed's target, policymakers have less reason to tighten monetary policy. With expectations of stable or declining interest rates, stocks appear more appealing to investors. Now, let's discuss the Federal Reserve, a vital force in the stock market. Many investors are speculating about its next actions. Will they cut rates, maintain them, or raise them in response to inflation? This week showed a cautious outlook for monetary policy. Softer inflation and weaker economic data eased fears of aggressive rate hikes. However, rising oil prices and bond yields coupled with inflation above the desired 2% target keeps a tricky balancing act for the Fed. Investors must closely monitor the bond market. The 10-year U.S. Treasury yield finished around 4.695% by the end of the week, a rise from the prior week. This matters because Treasury yields impact borrowing costs and provide a risk alternative to stocks. If yields increase significantly, investors may seek higher stock returns as compensation. The pressure on high-growth companies is heightened, as their valuations often depend on future profits while considering borrowing rates. Another significant development came on Friday. U.S. retail sales unexpectedly fell by approximately 0.6% in July, a surprise given forecasts for an increase. Initially, this weakness in consumer spending could appear negative for stocks. However, weak spending hints at slowing economic growth, impacting corporate revenue negatively. Yet, slower growth may reduce inflationary pressures, easing the Fed's path toward looser monetary policy and generating mixed market reactions. On Friday, S&P 500 saw a 0.2% decline. The Dow also fell by 0.2%, and the Nasdaq dropped by 0.3%. However, The Russell 2000 gained around 0.5%, indicating that the money was rotating between sectors rather than just selling off everything. 7 of the S&P 500 sectors finished higher, suggesting continuing broad participation despite the index decline. Thus, investors' behavior reflects careful consideration, evaluating economic data, interest rates, and corporate earnings. Let's now explore artificial intelligence. AI remains a major market driver as technology companies heavily invest in data centers and AI software. Investors are keen to identify which companies will capitalize on the investment cycle. This enthusiasm supports tech stocks, but raises questions about whether AI firms can generate sufficient profits relative to their lofty valuations. Robust earnings sustain high expectations, but falling short can lead to stock price declines. Nvidia, a critical player in AI, remains at the forefront as investors question the future sustainability of growth, examining spending and revenue translation. The technology sector acts as a significant market influencer. Notably, tech-focused funds saw approximately $4.62 billion in withdrawals, breaking a 6-week streak of gains. This movement suggests that investors may be shifting capital without abandoning the sector entirely. This week also highlighted the growth versus value investing trends. Growth stocks often benefit from anticipated future earnings and favorable interest rate conditions. In contrast, value stocks typically represent established businesses with lower valuation multiples. U.S. equity funds saw net inflows of about $2.58 billion, with growth equity funds receiving $8.78 billion, marking their strongest inflow since late 2024. This trend suggests a healthy mix of investment interest across various market segments. Let's focus on small-cap stocks. The Russell 2000's 1.1% gain outperformed both the S&P 500 and Nasdaq. This is significant because small companies react more to local economic conditions and rate changes. If interest costs decrease, small-cap firms that rely on financing might benefit, indicating investor comfort beyond large-cap tech stocks. However, single-week performance doesn't set a long-term trend, and monitoring future movements remains essential. Energy prices surged, with Brent crude oil rising 5.95% to about $88.50 per barrel. Elevated oil prices support energy company revenues, yet hinder overall economic conditions, increasing spending for consumers and businesses. This complexity complicates investor decision-making. While energy firms may thrive, the same high prices strain sectors reliant on lower energy costs, necessitating close Fed scrutiny of inflation. Not every sector performed uniformly this week. Energy thrived, while healthcare lagged, illustrating that the stock market isn't a single trade. The dynamics present opportunities across different industries, reflecting diverse investor behaviors across technology, healthcare, and financials. Recognizing sector rotation helps clarify broader market movements. Investor flows indicate important trends. U.S. equity funds experienced around $2.58 billion in net inflows, reversing negative flows from the previous week. Robust inflows into growth funds suggest positive investor sentiment. Simultaneously, bond funds attracted $9.4 billion, highlighting diverse positioning for growth, income, and liquidity. Looking globally, mixed conditions spanned international markets. European and Asian responses reflected individual data and geopolitical events. The TSX performance is crucial for Canadian investors, demonstrating interconnected market dynamics. Global events in oil or U.S. policies ripple through local markets, showing how modern investments are interlinked. Geopolitical risks continue to loom large. Uncertainties from the Middle East affect oil prices, which influence inflation and, by extension, stock valuations. A geopolitical incident can create ripples far beyond their geographic origins, reinforcing the importance of tracking global events. Despite challenges, investor anxiety stayed relatively contained, with the CBOE Volatility Index, VIX, dropping to approximately 14.25. A lower VIX indicates calmer market conditions, signaling investor confidence in the absence of imminent market crashes. Corporate earnings constitute a supporting pillar for stocks. Approximately 85% of S&P 500 companies have surpassed profit expectations, a strong percentage promoting stock price justifications. However, elevated market expectations require companies to produce exceptional results for significant stock price boosts. A notable stock story this week featured Reddit. Its shares skyrocketed over 13% upon inclusion in the S&P 500. Index membership can trigger increased demand, underscoring the importance of fundamentals while driving stock performance. Not all earnings reactions were positive. Applied Materials fell about 5% despite solid earnings results. This outcome emphasizes that investor expectations shape market reactions. It's not enough simply to earn. Companies must outperform expectations consistently. This brings us to the market's central dilemma. Can stocks rise as the economy slows? Currently, results suggest yes. However, limits exist. If growth slows moderately while inflation eases, stocks could prosper with stable Fed policies. Yet, dramatic slowdowns could diminish earnings potential, while escalating inflation may pressure valuations. The bullish case favors continued S&P 500 strength, an easing inflation path, stable interest rates, strong corporate earnings, and moderate oil prices. Meanwhile, the bearish case accommodates persistent oil prices, rising inflation, and weakened consumer spending impacting corporate expectations. Looking ahead, key indicators emerge. Investors should watch for Federal Reserve communications, Treasury yields, oil prices, and upcoming corporate earnings. Also, the Russell 2000's performance may provide insight into broader market trends. If you remember only 3 numbers from this week, let them be 7,785 and 6 for the S&P 500's close, 4.695% for the 10-year Treasury yield, and $88.52 for Brent crude oil. Together, they reflect the week's financial narrative. To summarize, the stock market remains resilient. The S&P 500 and Nasdaq rose. Small-cap stocks showed promise. Positive equity inflows recur. Corporate earnings stay strong. However, rising oil prices and Treasury yields present real risks, alongside weaker consumer spending. So, what did we learn? Despite complications, the market continues to climb. Understanding market mechanics, interest rates, inflation risks, and corporate performance is integral to navigating financial waters. And that wraps up your stock market weekly recap for August 10th through August 15th, 2026. This week, we've examined sectors, trends, risks, and investor behavior. If you enjoyed this breakdown, please subscribe for weekly insights. We'll explore not just what occurred, but why it matters. Understanding the market transcends mere numbers. It's about decoding the economy propelling them. Thanks for tuning in. Stay informed, stay disciplined, and I'll see you in next week's recap. As a final note, here are 3 questions for you. 1. What sector do you think will perform best next week? 2. How do you view the influence of oil prices on the stock market? 3. Which companies are you keeping an eye on in the realm of artificial intelligence? Please leave your answers in the comments below.